Hi, it's Larry Gaines, Power Cycle Trading. This video is going to be on momentum breakouts, progressions of a swing trade, and I'm going to take you through progressions of Google, some swing trades that I've done over the past 2 weeks to 3 weeks on Google using weekly options. But before I get started, I'd like to invite you to my upcoming webinar, and let me show you the link for that. I'll be doing a free webinar this coming Thursday, June the 13th, and it'll be from 8 to 9 p.m. Eastern. It'll be on powerful tools that I use that every trader must know for day trading and swing trading. So please join me, and you'll see this link also on the email for this video. But if you're not able to get the link from the email, just go here to our website, Power Cycle Trading, and our go to support. But here's the link, so make sure you join us this Thursday, June the 13th. Now, there are a lot of elements to trading, and one key element is to be ready and have a plan for your trades. It's hard to try to find everything that is moving to trade, so I like to have a certain screener that I can use, or I like to have a watch list with a few stocks that I'm familiar with to track and trade, and then when I see really good potential, then I'll stick with that particular stock and trade it over and over. So this is a progression of some Google trades. So I'm going to go through those real quick with you, but here's the first trade, trade 1, and these were shorts. Based on our trading model, we have the model, which you can't see here, but our trading model, Power Cycle trading model, had Google overbought and looking like it was about ready to turn over. We got a short signal here on the 16th of May. So I took my first trade, which was a put vertical bear put spread, and I'll go through that in a minute. And then came down, covered the trade here, covered the trade on the 17th, about 2 days later. I actually put the trade on the 15th, covered this trade the 17th, put on a second trade on the 20th of May, another put spread, and I saw this gap area. This was a gap that did get filled, so I wanted to take advantage of the gap right here, the 900 down to 890. So I did a put spread that incorporated this gap. It was a very successful trade. Took it off here, and Google went sideways. Our system was still short. I took another put spread on Google right here on the 3rd of June. It was down into some key support area below, which was coming into about the 50-day moving average. So my next trade setup was going to be pretty much, I figured, to the long side. So I covered the put spread here on the 7th, which was Friday, yesterday, and I went long a vertical call spread to take advantage of the breakout based on our system. So I'll go through those real quick with you just to show you how these trades turned out. Now, the thing that I really like about using weekly options with my trades, especially swing trades, is that I can define my risk at a very low cost, and options, if you know how to use them properly and know how to incorporate the benefits of time decay and volatility, you can really do some other type of adjustments and other creative things to your option spreads, and that give you various options, so being the name options. So the first trade on Google was a short, and I did that through a bear vertical ladder put spread, and ladder or ratio spread just means that there are additional legs in order to take advantage of time decay. So in this trade, this was put on the expiration on the May 18th, put on the 15th of May, and that was that first trade I showed you, trade 1 on the chart, if you want to back up and look at it. So I went long the 905 puts, short the 900 puts, and I did that spread. Basically the spread was at $190 a contract, and then I sold the upside calls against it, collected 125, sold the upside 935 calls on the 16th, a day later, collected $25. So my total cost on this was $40 a contract. So I like to do this type of strategy on weekly options when there's time decay, so I can incorporate taking advantage of theta or time decay and accelerating, so I sell some additional legs, and I have a certain way that I do this using my trading system. And then I took this off the 17th, and I actually legged out of this particular trade, and the end result was I made $410 per contract. So on the 17th I sold off the 905 puts, broke even on that, bought back the 900 puts that I was short on the spread, made $260. The options I was short expired out of the money, so I made $125 there and $25 there. So the total profit on this particular trade in 3 days was $410 a contract. The next trade, trade 2. Trade 2 was another, based on our model. We were still in a downtrend on Google, and this one was to incorporate a gap area. So let me show you that one more time. Now, I love to trade big gaps, and here was a very major gap right here. It's marked by the green line here. This was at the bottom was at 900, and then to fill the gap was down at 890. So I just bought the 900, 890, $10 spread using options on Google to take advantage of this. The system had a squeeze, and it said it was high probability to trigger to the downside, and it did. So this trade turned out really well. So here's trade 2. Did the 900 long put, short the 890. So I got into this trade at a debit of 370. Had a $10 spread. That's $1,000 per contract, the width of the spread. I took it off 4 days later, and I actually legged out of it. The thing was, I was long the June 7th expiration, and I was worried that it might get a big bounce, so I wanted to go ahead and close the trade out. If I'd left it on, I would have made the full value of this spread, so that would have been $1,000 a contract minus my cost, which in hindsight I should have bought the week earlier expiration. But anyway, this total spread, when I did get out of it, I made $290 a contract, 78% return on my capital at risk, which was $370 there. So that was trade. Now trade 3 was another short on Google. I was pressing Google. The trend was still down. There was not really the major support I was seeing came in at the 840 level. Let me show you that. So here's a daily time frame. You can see here the support level, this pivot high, that came in at 844, and then you had a 50 period moving average down here at 838. So I thought it would come down to this pivot high here, and maybe even to the 50-day moving average. It did make a low of 848. This was on Thursday, and this would have been the optimum time to take it off, but we had employment number coming out Friday yesterday, so I thought I would just go ahead and hold it through that in case it just really took a nosedive. But my next trade setup was to look for a long going the other way, so I'll show you how that turned out. In this trade, I had it hedged out really well using weekly options, so I'll show you what happened on this trade 3. So I was long the on the 3rd of June. I went long the 855 puts, short the 840. So I had that put spread on, and I had that put spread on at $220 contract. That was my max risk or capital at risk. I also shorted below the 825 puts. This was another ladder put spread, and below that the 815 puts. And I did that based on some other indicators and the way that I look at support resistance. And I felt comfortable that we were not going to get down to this level, being weekly options, only having 2 days left. So I took advantage of selling additional out of the money options against it for time value and time decay. Collected $155 there, collected $57 contract there. End result was optimum. I should have taken this off on the 6th when it bottomed. It showed a bottom, but I wanted to hold through the employment number. I could have been out of this at a nice profit, but I wanted to go for the big home run. And these options were almost, worthless yesterday on Thursday anyway. So I was in good shape there. So what happened after I took off this whole trade? I ended up making $2 a contract. So I broke even basically on trade 3, and then trade 4 was a reversal trade to the upside. So trade 4, the optimum entry, our signal actually on a 60-minute time frame, our model went long right towards the end of the day on the 6th, right here, and you can see how it really broke to the upside. So this was a cycle low. Our model gave a long signal, and this would have been the optimum point to put the trade on. I wanted to wait till the next day to see what happened to the employment number, So on Friday, here's Friday, and here's the open. You can see had a nice trend line breakout. Our model was already long, so ended up buying into this trade at about 10 o'clock right here. And instead of buying the shares, I did the following option trade. So I bought the vertical bull put call spread, excuse me. Entry on the 7th of June, that was Friday. It expires next Friday. So I went long the 875 calls. Those cost $7.95, short of the 880. This is as a spread at 560. So I am long that call spread, and my cost of this spread is, what is that? Spread cost is $235 a contract. That's my maximum capital at risk. The spread is a $500 spread. Max potential profit is your 500 spread minus your cost. So it's $265 contract. Max return on capital, 113% return. As of the close on Friday, yesterday, the spread was at $330 a contract. I put it on at $265, so I had $95 per contract mark to market. Or over a 40% return if I closed it out yesterday. But I'm going to hold it and see how it does going through next week. Now what I'll do is I'll potentially hedge it out by selling some out of the money calls against it or out of the money puts against it to take advantage of time decay and theta using the weekly options. So here's a quick look at the option chart. Here's the 875 calls. These expire on the 14th of June, so bought those at $7.95 right there. Nice push to the upside. To hedge it out, I sold the 560, collected 560 premium by selling the 880 a call above it, the $5 spread. So I have this on at $235, and I am looking to see how it maxes out by next Friday. And if it starts stalling out, I'll sell some out of the money calls above the market, probably around the 915 or 920 calls to collect some premium there to help take advantage of that theta or time value decay. Hope this helps, and make sure you tune in for my webinar this Thursday, June the 13th. So 5 powerful tools every trader must know for day trading and swing trading. It's a free webinar, so don't miss it. Thursday, June 13th at 8 o'clock Eastern. See you there.